Welcome, empowered investors. I am coming to you from beautiful Medellin, Colombia, or as the locals say, Medellin. I just can't quite get myself to pronounce it that way, but that is the correct way. Anyway, got a couple of data points here I want to share with you before we get into today's topic, which is fundamental stuff. 10 commandments of successful investing. This is just core content that so many of you say you want to hear. So that is coming up for you in just a moment. But first, some foreclosure data. Foreclosures. How bad is the foreclosure market? How realistic is the stuff you hear from the doomers? Now, certainly the real estate market, I have reported many times, has been pretty darn boring for the last year. And I think we're going to see that continue for just a little bit longer. But I think it's about to unfreeze. And I heard a very, very interesting theory. Wow, kind of blew my mind this morning from Anthony Pompliano, and it was about the Trump administration trying to intentionally slow the economy. Yes, I know that sounds absolutely nuts, right? Why would any president want to do that? Well, I take that back. There are some that did want to do that for sure. But I don't think this president would want to do that. However, there has been a lot of pressure and a lot of talk about forcing the Fed chair out, forcing the Fed to lower interest rates, which would obviously speed up the economy. We all know that. And you probably saw, and we reported on the news about how Jerome Powell was being extremely defiant about that. And, I don't blame him, right? The Fed is supposed to be separate from the government, but whatever, right? And Richard Duncan, when I interviewed him in Bangkok live in person, you heard that just recently, he talked about the end run around the Fed, which the Trump administration could do. But here's another way. Here's another way they might be trying to do it, and that is to just generally slow the economy. We are going to have some bumps in the road, folks. Get ready for it. It's definitely coming. Trade wars, tariffs, chaos. It's a lot of stuff going on. But through it all, the most historically proven investment will be income property. And we just don't see any sign of any big doom and gloom as you hear from some of the doomers, like Peter Schiff, who's been wrong since 1982. I didn't actually say that, but you heard me repeat it before. I was on this live stream with Peter, and he was talking away, and he sounds so brilliant. And he is a really smart guy. There's no question about it. But someone wrote in the chat, Peter Schiff has been wrong since 1982. And that's pretty much how it is with the doomers. They just underestimate the power of human ingenuity and the power of 8 billion people waking up every single morning thinking one dominant thought, which is, how can I improve my situation? And as they do that, they're going to create value in the economy, value for others. And it's just a beautiful system the way that works, right? But here's some foreclosure activity. And it is still extremely low. In fact, it got even lower than extremely low. If you're watching on video, you see this chart, and back to the Great Recession, foreclosures were through the roof. There was so much foreclosure activity. It was unbelievable. And this chart that I'm showing on video looks like just a pointy chart at the top of the Great Recession. And since then, foreclosures have been pretty much just declining. During the COVID era, they declined even more to incredibly low historical lows that even if you go back much further, they were never that low. And there were the foreclosure moratoriums, right? We know about that, the eviction moratoriums, the foreclosure moratoriums, that all happened. But we didn't really need that at all, because think about it. Think about the COVID era and all of the doomers and all of the doom and gloom you kept hearing. You saw it all over YouTube. In fact, my buddy Ken McElroy made a video. He said, write this year off. And so many of you asked me about that video because Ken and I are business partners. And he was super negative about the whole thing, as were so many other people. And so many other people were saying, I've got cash, I'm going to pounce. This is going to cause an immense real estate crash. And it didn't. All of those people missed out because it went the opposite way. The real estate market boomed. And one of the reasons was that they underestimated the government and the central bank response to the crisis. And as they underestimated that, the market went through the roof and we saw massive appreciation. We all know the history, right? But think about it. If you are one of those people trying to time the market, you would have just completely missed out on that. In fact, you would have missed out on a lot of good cycles. But that said, we don't even depend on cycles. What we depend on is just reliable investments that produce a good overall return on investment. And if you want to know how to calculate those, go get that free video at jasonhartman.com. It's right on the front page. And look at the performas in the properties section of jasonhartman.com. And you'll see that even with very conservative assumptions, they perform at above 20% annually, because income property, of course, is this beautiful multidimensional asset. Unlike other assets, you make money in many more ways. And so back to the foreclosure activity here and how everyone just screwed up on their predictions about what would happen and about the way they dealt with it and the way they were keeping their powder dry and waiting to time the market. And they were just wrong. They just totally missed out. Over and over again, this happens throughout history. And so this foreclosure activity went up a little bit as the moratoriums went away after COVID, right? There was a little bit of an adjustment, but it's still the lowest foreclosure activity on this entire chart that dates back over 20 years. And now foreclosure activity even went down slightly in the last month. So again, all of the doomers, they just miss out all the time. And nobody ever counts what they miss, right? Because that's not the way the human mind operates. You can't hear the dogs that don't bark. Sure, everybody talks about the one that got away once in a while, but a lot of people just don't talk about it at all because, well, they're kind of embarrassed, honestly, that they missed out and they didn't have the confidence to do things that would have yielded great returns for them. So here's another chart I'm showing, and this is the percent of loan balances that are 90 days or more delinquent by different loan types. Okay, so credit cards, auto loans, mortgage loans, and they separate out HELOCs because that's a different kind of mortgage, a home equity line of credit, and then student loans. So we've got these 5 different types of loans. And where would you think the biggest delinquencies are? Well, of course, they're in credit cards. Now, they've gone up recently, but they're certainly not the worst they've been. They were much worse during the Great Recession. And right now they stand just over 11% of people on their credit cards are 90 days or more delinquent in paying the bill. And then you look at auto loans, and you've got about 5% of people that are 90 or more days delinquent on their auto loan. Now, what isn't this telling you? Well, we have got one of the oldest auto fleets in quite a while, maybe ever now on the market, because these cars are so much better than they used to be. And no one really interprets that. They think about, oh, the cost of cars went up so much and, all of this, but they don't think about how much better the car got. In fact, if you are old enough, and if you were alive in the 70s and 80s, for example, and of course before that, in the 60s, the 50s, definitely before that, but even back to the 70s and 80s, not that long ago, it was a legitimate excuse that is not a legitimate excuse now, okay, at least not in the US, right? It was a legitimate excuse back then to say I was late because I had car trouble. Just think about the last time you ever heard someone make that excuse. I was late because I had car trouble, car repair problems, right? Nobody has car trouble anymore because the cars are so good and so reliable nowadays that that's just not even an excuse. But it used to be an excuse. just recently, 60s, 70s, 80s, right? That was a legit excuse to say I had car problems and that's why I couldn't make it, or that's why I was late, right? It's not a legit excuse. No one would believe you. Like, what would be your car problem nowadays? The car starts every time. It works. It gets you there. It's just never a problem. So one of the things this chart isn't telling us is that the fleet has gotten much older, the fleet of automobiles out there. Usually it takes about 12 years to replace the entire fleet. So when self-driving cars come out, that'll be such a giant innovation that everybody will rush to replace the fleet. In fact, I would predict there'd be some government pressure or regulations requiring that people replace the fleet. But that's a whole nother discussion. Cars as a service, like SaaS, software as a service, CAAS, cars as a service, that's definitely coming and coming really quickly. But a lot of people have paid off their cars. So what this doesn't tell you is that, yes, delinquencies are kind of high. They're not super high. They were just as high, about 2019. They were just as high as they are now. And they were just as high during the Great Recession. Interestingly, not higher. So they stand at about 5% of the people are 90 or more days delinquent on their auto loans. But a lot of people don't have any auto loan at all. See what it doesn't tell you? Why that's so important, right? So they have no auto loan, so they can't be delinquent on a loan they don't have because their car is old and they've paid it off. All right, mortgages, extremely low delinquency. And if you're looking at the chart, you saw that 9% of people were delinquent on their mortgage during the Great Recession. Just a huge number, almost 1/10 of the entire mortgage market. And HELOCs, same thing. Very few delinquencies on the HELOCs. And they also put in here student loans. Now, student loans are different. A lot of people would love to be delinquent on their student loan because after they graduated, they probably realized their student loan was largely a scam. And it was. College should be way less expensive. And it's a big, giant scam. But that's another topic. We've talked about it before. So people aren't delinquent on their student loans because they can't bankrupt out of them. They're an unbankruptable, unforgivable loan. So again, there's no relief for student loans. But these mortgages, people are extremely comfortable and they have no incentive to be delinquent on their home mortgage because it's so cheap. Now, it is changing a bit, and the mortgage lock-in effect is slowly going away, very, very painfully slowly, because that would free up a little more inventory if it went away and there'd be a more dynamic market than we have now. But anyway, you've got about 25% of the people still have a mortgage at or below 3%, about 65% have a mortgage at or below 4%, and about 85% have a mortgage at or below 5%. So still super cheap mortgages, but what doesn't it tell you? About 40% of the people have no mortgage at all. So again, super low default rate there, very comfortable people, not selling, not crashing the market, far from it. We're just in kind of this, I would call the real estate market. The economy in general, and I predicted this right at the beginning of COVID, I predicted stagflation. And I do think we're definitely seeing some stagflationary vibes going on. It's not really stagflation. It's not like the stagflation of the 70s, but we are seeing definitely, I think we could call the real estate market somewhat stagflationary because there's not much activity, but prices are still rising, and they're not rising as much as they were, but they're still overall rising. And on an episode coming up, I've got a breakdown market by market in a whole bunch of major metros. Have you ever wondered how the top real estate investors consistently find the best deals before anybody else? Well, listen up, because this can transform how you invest. I'm excited to share something that's revolutionizing the real estate game. It's called Connected Investors. This is a really cool platform that gives you access to all of the property records nationwide. Truly amazing. It's not just a platform, though. It's a secret weapon. It does a whole bunch of things. Besides the property data, it's a social network as well. It's built by successful real estate investors for real estate investors. Find off-market deals instantly, access accurate ownership contact info, make smart data-driven decisions, and secure funding for your deals from a vast network of private and hard money lenders. Whether you're a beginner or a pro, Connected Investors is your go-to tool for smarter, faster, and more efficient investing. Try a 7-day free trial at jasonhartman.com/connected. Again, that's jasonhartman.com/connected. And let us know how much you love this software. So, Empowered Investor Live is coming up too. You got to get your tickets and register and join us for Empowered Investor Live. Before that, though, I will tell you, we have a masterclass coming up, and you can register for that. jasonhartman.com/Wednesday for our monthly Wednesday masterclass, and jasonhartman.com/Wednesday. And for Empowered Investor Live, if you'd like to join us for that, meet all of us in person, have a great time. We will be in Southern California early April. Registration link for that is empoweredinvestorlive.com, empoweredinvestorlive.com.